Shukran, Hutham. Thank you very much. Bismillah ar-Rahman ar-Rahim. It gives me a great pleasure to be back at this August gathering of business people from both countries, Saudi Arabia and the United States of America. Therefore, I have a great pleasure to be here again, as I said. And since I have been asked to share my views on shared responsibility for maintaining a stable global financial system, I would like to focus first on policy challenges, regulatory reforms, and the issues of the reserve currency, and to briefly touch on the challenge the Eurozone poses at this moment. Finally, I will conclude with our experience in preserving financial stability in Saudi Arabia, or what I call safeguarding the home front. It is well known that the global financial system was shaped by the developed market economies in the post-World War period, at a time when emerging market economies were not that significant at that time. The recent global credit crisis had its origins in the advanced economies and consequently has affected the emerging market economies, particularly as global banks withdrew their funding in order to take care of their funding requirements at home. Let me highlight macroeconomic policy challenges. The latest IMF Global Financial Stability Report states the risks to stability have grown for the first time since October 2008. So now we're going into another crisis after 2008. Both the developed market economies and the emerging market economies have problems, but they are not the same. And the contrast is ultimately due to different levels of indebtedness and a different approach to counter-cyclical debt management. The developed market economies ran primary budget deficits during the boom years before the crisis, when they should have been paying down their debts. Their flawed macroeconomic policy was matched by lapses in financial regulation with the so-called light touch regulation. This allowed banks to increase their leverage, while an unregulated or lightly regulated shadow banking system mushroomed. Meanwhile, consumers were encouraged to take on excessive debt, particularly housing debt. The end result is that there are high levels of debt in the developed market economies, and many financial institutions have become vulnerable. Meanwhile, significant expansionary policies, including liquidity support for banks, were put in place, while credit ratings of developed market economies were being cut. However, the developed market economies need to shift away from short-term and ad hoc measures to support markets and the economy and move towards a long-term plan to reduce government debt to GDP and cut leverage in the financial system. Only in this way can fiscal sustainability be restored before the demographic wave of aging population becomes a more serious fiscal challenge. In emerging market economies, by contrast, fiscal and monetary policies have been, on the whole, more prudent. But now the need is to prevent overheating of the financial system from damaging the real economy. Credit flows from the developed market economies have been, to say the least, a roller coaster ride for many emerging market economies over the last few years. In the MENA region, our region, for example, commercial bank lending from the outside was about $144 billion in 2007. But by 2009, it was negative as funds were withdrawn. This year, it is expected to be just about $3 billion US. The first stage in the roller coaster ride was when the crisis broke out. Global banks withdrew their credit lines to local banks in the emerging market economies, and this transmitted the crisis around the world. As emerging market economies tried to shield their growth from the contagion flowing from the developed market economies, one consequence was rapid credit growth. For example, Chinese credit growth was over 50% in 2009-2010. In the second stage, bank lending and portfolio equity flows from the developed market economies flowed again into the emerging market economies as interest rates were cut to near zero in the major economies. So emerging market economies were coping with credit growth locally and flows from abroad that can overwhelm the capacity of local markets to absorb them. Authorities used quantitative measures to mop up excess liquidity through, for example, raising reserve requirements or capital controls of some kind. Now, economic prospects have deteriorated in developed market economies once more, and banks and investors are withdrawing liquidity again. The result is that emerging market economy currencies are weakening, as in Brazil and South Africa and India, and emerging market economies' stock markets were trending down. The most important thing that the developed market economies can do to support the global financial system is to provide a stable fiscal and monetary environment and prevent the violent shifts in global liquidity conditions that can overwhelm policymaking in the emerging market economies. One final note or thought to leave with you there. This crisis of 2008 and now would not be in vain if, for example, the Chinese rebalance internally their economy where domestic demand and consumption rise and savings decline, and the US and Europe rebalance towards more fiscal prudence and higher saving rate, particularly in the US. Let me talk about regulatory reforms. The pre-crisis monetary stability was paradoxically the harbinger of financial instability, as it encouraged banks to increase leverage and behave imprudently. Weak financial regulation in the major economies was, in my view, the single most important cause of the global financial crisis. The banks persuaded regulators that only a light touch approach was needed, and national regulators competed with each other in a race to the bottom and weak oversight to attract financial business. Regulation was in some places separated from the central bank, and the result was suboptimal. Emerging market economies did not have the same problems because, by and large, they kept to a conservative, unified form of regulation. Now there is growing pressure from bankers and politicians in developed market economies to delay the implementation of Basel III because they claim it will lead banks to reduce the supply of credit. But the Basel III requirements for more and higher quality capital and tighter liquidity rules is crucial to building a more robust global financial system and avoiding regulatory arbitrage. For example, ensuring a level playing field and a race to the top. Banks will try to minimize the impact on their profits by moving business to tax havens or less heavily regulated jurisdictions. The Financial Stability Board, or the FSB, has a clear mandate to increase the international coordination among policymakers, financial regulators, supervisors, and standard setters. Central bank cooperation and timely implementation of Basel III will test our shared responsibility for the international monetary system. Indeed, within Europe, there is still debate about how much power should Brussels have and how much should remain with the national regulators, such as the Bank of England. My own view is that it is better to have national central banks in charge of commercial bank regulation. Meanwhile, SAMA fully intends to implement Basel III requirements on schedule. Let me say something about reserve currency issues. My third topic for discussion is the future of the reserve currency. After World War II, the international monetary system was built around a single currency, the dollar, or what was called the dollar standard. It does three jobs. Any reserve currency has to do three jobs. One, acts as a pricing numeraire for commodities such as oil, facilitates payments, and also serve as a store of value due to the unequaled, unparalleled US market depth, liquidity, and variety of assets. Those were the attributes that made the dollar the ultimate reserve currency. Some protagonists and commentators these days want to change the system. I agree that the international monetary system must evolve to accommodate more than one global reserve currency and numeraire, but this challenge is, in my view, not properly understood. Let me start with a basic economic statement. The world needs a growing supply of liquidity to match the growth of the global economy and trade, because without it, the global price level would fall. That's actually what happened with the gold during the gold standard. This liquidity today comes from the US current account deficit. Running a current account surplus, as China, for instance, does, means you don't supply liquidity outside your economy. In fact, you build up foreign exchange reserves and withdraw liquidity. The benefit for the US is that because of world demand for dollars, it can run lower interest rates and a wider budget deficit than would otherwise be possible, and sometimes even prudent. In other words, the dollar has an exorbitant privilege. Just Kurdistan used that term in the 70s. But there is a duty attached to the reserve currency to go with that privilege, i.e. maintaining confidence in the reserve currency, in this case the dollar. Lately, there have been calls to artificially expand liquidity through the SDR, or the special drawing rights of the IMF, to expand the list of reserve currencies. But the SDR is not a currency. It is an artificial reserve asset. At best, the SDR could be an add-on to reserve currencies. It does not intrinsically provide a store of value. Alternative currencies are not obvious, as neither Europe nor Japan run the large deficits required to supply extra liquidity to the international monetary system, and the Eurozone is facing its own major crisis. The best approach is not to force the pace of change on such a vital issue. Let the markets themselves decide on whether alternative reserve currencies are worth using and holding. This will encourage China to liberalize its external capital account and will force US policymakers to improve their policy mix for fear of losing the dollar's privilege as the prime reserve currency. On the Eurozone, there is a brewing risk to the international monetary system as a result of the escalating sovereign debt crisis in Europe. One area of concern is the concept of zero risk weighting for sovereign debt, which is embedded in the banking system, for example, for collateral. If banks started to risk weight sovereign debt, they would have to hold more capital and raise borrowing costs for developed market economy sovereigns. My second concern is that structural reform policies in the Eurozone may not have time to work. Policymakers may force further austerity and make the prospects of robust growth a more distant one. Bailouts of banks and sovereigns in Europe could draw on the IMF, but this would be difficult for emerging markets to accept given the wealth of Europe. The ECB is treading a fine line by supporting troubled banks, but not buying large amounts of not buying large amounts of sovereign debt, and we must hope the crisis is it's not but, it's misspelled. By not buying large amounts of sovereign debt, and we must hope the crisis is satisfactorily resolved. And of course, you've been watching the news, and the Financial Times today had an article on that. But I think we will believe it when we see it. The markets are jittery, and the political machinations of agreeing what needs to be done is at a very, very sensitive stage. Everybody is waiting for December 9th, and I wish them all the luck. Currently, The Eurozone crisis is a headwind for the global economy, and so it needs to be resolved promptly to avoid contagion and growth stagnation. The ECB's role is critical in the short run as austerity measures take time to work. The long-run solution is to amend the European treaties to bind the members to ceilings on debt and borrowing, as was envisaged when the euro was born. Finally, the sovereign debt crisis in some of the Eurozone countries is a wake-up call for prudent fiscal management in all countries to avoid having to take emergency measures at a significant financial and social cost. The latest developments indicate that the scale of the crisis is bringing about cooperative measures to deal with it. The rate of interest on central banks' dollar swap lines has been reduced by 50 basis points recently, and this should help ease the funding pressure for some euro area banks. The ECB could step up its program of supporting mod markets if the prospects for sorting out the fiscal problem improves. This is all encouraging, but there are still lingering concerns in terms of adequacy of the EFSF resources, policy implementation, and short-term growth prospects in the Eurozone due to fiscal austerity and the high cost of debt servicing. Let me brief you in Saudi Arabia, on our fiscal focus and approach to financial stability. We have for many years pursued a counter-cyclical approach, i.e. paying down our government debt during the upswing of the cycle, and in our case, upswing cycle is higher oil revenues, be it through prices or quantities or both, and running budget deficit during the downswings in order to cushion the economy so it does not go into a tailspin as when oil prices sometimes do. For example, between 1999 and 2007, government revenues, mostly from oil, rose from 30% of GDP to 70% of GDP. But government spending stayed at around 30 to 35% level. We used the upswing to run budget surpluses and prudently reduced our government debt to GDP from 100% to around 7% now, and at the same time replenish our foreign exchange reserves. The result was that we were able to shirk the global recession of 2008-2009 and briefly run a budget deficit in 2009. As for our regulatory framework, SAMA acts both as the central bank and commercial bank regulator. This gives us a better oversight over all aspects of the banking system. In fact, our policy of monetary tightening through policy rates, reserve requirements, and macroprudential guidelines for bank credit during the period 2005 until the emergence of the global crisis was very helpful in restraining the pace of credit growth. In the period leading up to the crisis, working together with our banks, we made sure that they had minimal exposure to credit derivatives and maintained adequate loan loss reserves. The result was that when the crisis struck and global banks withdrew their credit lines, the Saudi banking system proved to be fairly resilient. It is quite obvious now that in a complex financial system, it is rather unrealistic to expect that only one specific measure, such as risk-weighted capital ratio, could detect any risk of financial fragility. It is therefore imperative to broaden the scope of risk detectors through macro-prudential rules, for example, credit to GDP ratios, loan-to-value ratios, dynamic provisioning, etc. Our approach to banking regulation seeks to apply counter-cyclical micro and macro-prudential measures, and requiring the banking system to hold more capital on average will not improve the resilience of the financial system as a whole unless there is also a better match of risk-taking to risk capacity. Our banking sector is the least leveraged in the region, and we are not complacent about the resiliency of our system. Indeed, we are very much in favor of conducting periodic stress tests for our banks to ensure that they remain in good health. In short, our priorities are to maintain the dollar-real exchange rate stability, closely monitor credit growth, and ensure that the banking system grows in tandem with nominal GDP. We are well aware that we are not immune to global developments, as there will always be indirect impact and contagion winds. Of course, it goes without saying that Saudi oil policy has contributed immeasurably to global economic stability. Keeping a comfortable oil production spare capacity has dampened instability in oil as well as financial markets. Let me conclude. It is in the interest of both developed market economies and emerging market economies to safeguard the openness of the global financial system. It has supported a huge wave of global growth and prosperity in the last 30 years. Indeed, much progress has been made in international cooperation since 2007. For instance, the IMF has set up more flexible loan facilities with less conditionality for economies in need. Central banks have also implemented swap lines. The Financial Stability Board has made much progress in a framework for regulating the systemically important financial institutions, or SIFIs, or G-SIFIs these days called. The developed market economies bear a heavy burden to move away from their history of reflating their economies through debt and ad hoc measures. They need to reflect upon the lessons of the crisis and follow long-term policies consistent with financial stabilities. The policy shifts in the developed market economies, especially through quantitative easing and zero interest rates, have led to large shifts in global liquidity conditions and have placed great stress in emerging market economies. Government finances in developed market economies have been unbalanced for many years. Keynes would have been horrified to think that his vision of using government spending to stimulate the economy out of the 1930s type depression would lead to permanent budget deficits and debt to GDP levels that ran up in good years as well as bad until they have reached unsustainable heights. Keynes thought that a budget deficit in 1 year would be balanced by a surplus in another year so that debt to GDP levels stayed stable over time. That is the counter-cyclical policy for the long run that Saudi Arabia has been following. The political pressure on policymakers have prevented this happening in developed market economies. There are still many commentators who push for even more deficit spending to restore growth. But for global stability, it is more important that developed market economies convince the markets they have a long-term plan to fix their finances. That is the single biggest contribution they can make to preserving the stability of the global financial system. Failures of banking regulations were at the heart of the crisis. Microprudential regulation needs to be augmented with macroprudential measures to protect financial institutions from systemic risks. Crises may not be avoided, but they could be fewer and milder through better regulation. Thank you very much for your attention.